Kotak Platinum Plan. Will this ULIP help you achieve your financial goals? Will this ULIP help you create long-term wealth? Let us explore and evaluate. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decisions. Before we evaluate this particular ULIP policy, let us first understand the basic key features of this particular policy. This policy is a unit-linked insurance plan. Means this policy will give you life cover. For that, they will charge you, and there will be some additional charges. We will discuss about the charges later in detail. In addition to all these charges, there will be some investment portion left out. That investment portion will be invested in multiple investment options given by them. It will work like mutual fund schemes, right? Which will in turn invest in stock market and money market related instruments. Because the underlying options schemes invest in stock market and money market, there is a possibility for volatility ups and downs. So unlike a traditional endowment money back kind of conventional plan, this fund is not a highly safe fund. This is basically a fund which takes a risk. This is a risk premium product. This is not a risk-free product. Right. So people who are comfortable taking risk, for aggressive investors who understand volatility in the stock market and money market, then this ULIP option can be explored. And one more thing, what we have to check is people who are not comfortable with the FD kind of returns, who are looking for risk premium return by taking a risk in stock market, then they can also explore this particular option. This policy gives you flexible premium paying term. Rider selection is possible. You can also do partial withdrawals. Depends upon some terms and conditions. We have understood the key features, and there are basically two benefits in any insurance policy. One is death benefit and the other one is the maturity benefit. Let us first understand the death benefit in detail, then we will go on to the maturity benefit. Right. This policy has got three different options. Right. One is a self-managed strategy, age-based strategy, systematic switching strategy. Right. So if you are someone who is comfortable investing on your own, right, then in that case you can go for self-managed strategy. There are multiple fund options given to you based on the risk appetite. You can pick and choose any combination you want. Also later on you can switch from one option to other option. If you are an investor who knows which funds to select, which fund is performing, which fund will perform, if you could do all these analysis, then you can go for this self-managed strategy. Next is age-based strategy. No, I'm not comfortable assessing my risk and the return ratio, and based on that, you can choose the right funds. Then go for this age-based strategy. Based on your age, the company itself has got some predefined ratio in which your money will be allocated to certain equity funds and certain debt funds. Right? What ratio they are doing it is depending upon your age. If you are very young, you will have higher allocation towards equity. If you are like closer to your retirement, like 60, then in that case, then like you will have much lower equity ratio. So that way, age-based strategy will work on predefined allocation. Then systematic switching strategy. This strategy will work like a systematic transfer plan in mutual funds. You will invest money in some fixed income fund in the option. Then from there, you will be moving the fund to an equity fund slowly over a period of time. So this is systematic switching strategy. You will invest lump sum, but not into stock market based funds, in money market based funds. That lump sum will be slowly gets transferred every month, like some portion for 6 months, 10 months, like that. You can do automatic switches. Right. So This policy has got convenient premium option. There are some additional protection available. Partial withdrawal is available. Maturity benefit, death benefit. This policy also gives you Section 80C tax benefits, right? So we will look at the fourth and fifth point, that is maturity benefit and death benefit in detail, right? So what kind of death benefit this policy brings to the investors, right? In case of any unfortunate death of the policyholder, then the insurance company, Kotak Life, calculates three values. Out of these three valuations, whichever is highest, that will be given to the nominee in case of unfortunate death of the policyholder. So, basic sum assured, then value of the fund as on date of the death claim, then 105% of the premiums paid. So out of these three values, whichever is higher, that will be given to the nominee in case of unfortunate death of the policyholder, right? So we are clear with the death benefit. So we have to see what is the death benefit, right? Before looking at the death benefit, it may be worth to consider what are the charges involved in this particular policy. Why charges before a return? Because the policy in their benefit illustration from their official website, they give you return like worst case scenario 4% and best case scenario 8%, but that is not the actual net return we are getting. That is basically the gross return. There are some charges which pulls down the overall return. So it is necessary for you to understand what are all the different charges involved in these schemes. There is premium allocation charge. This is the charge whenever you pay the premium, they will charge an entry charge. This is kind of an entry load. Entry load is abolished in mutual funds long back, but it is still there with ULIPs. Premium allocation charge. Now for in the first year it is 5%, then 3%, then 1.5%. Policy administration charge is also there. This is also another additional charge which is not there in mutual funds. Fund management charge, this is justifiable charge. Only thing, the discontinued policy fund charges are much higher. Rest of the charges are justifiable, maximum of 1.35% only. There are switching charges, there are partial withdrawal charges, there are discontinuance charges, there are mortality charges. Again, mortality charges is an acceptable charge because they are providing you life cover. Miscellaneous charges for replacing policy document, alteration of basic sum assured, premium redirection, like for all these things, they are charging you heavily, right? Out of these 8 charges, only 2 charges, fund management charges and mortality charges, these 2 are justifiable. The rest of these 6 charges are completely not justifiable, and these 6 charges are not there with any mutual fund schemes. That we have to clearly understand. That is the difference here, right? As we have understood the charges, now let us see what is the maturity benefit. Let us also compare that maturity benefit with an example of a combination of PPF plus term insurance, right? In the worst case scenario, in the example taken from the official website of Kotak Platinum plan, the benefit illustration says in the worst case scenario, it will give 4% gross return. After charges, the net return works out only to 2.03%. Right? So the maturity benefit is only 37 lakhs. So in the best case scenario, the maturity benefit works out to 58 lakhs. Means the net return works out to 6%. The gross return is 8%. Whereas PPF gives you 7.10% as gross return. If you add life cover mortality charges to it, means if you divide the investment amount into term insurance premium plus PPF, like that, if you divide, then it works out to 6.11%. So the detailed assumption, like based on which we have calculated the entire benefit illustration, is shared in our website as a detailed research analysis. I have given the link to that particular blog post, the research post below this video in the description box. You can click that link and read the complete calculation of this 2.03%, 6.07%, and the logic behind the maturity value of PPF plus term insurance calculation. It is given in detail in the blog post that you can click and read it. Now, if you compare all these, like three, worst case scenario, best case scenario, and PPF return seems to be definitely on the much higher side, because PPF is a very simple plain vanilla product, and PPF is a government scheme. 7.10% is an assured return. Kotak Platinum plan is a risk premium product. It invests in stock market and money market, whereas PPF is a risk-free product. Even after taking a risk, Kotak Platinum plan is underperforming and not able to outbeat even a simple no-brainer PPF investment. So what does it convey? What is the insight we have to get from this? Is because of the multiple charges in this particular plan, it brings down the overall return. That is why they are not able to give you the actual risk premium return. That is why they are not able to give you a good long-term return. That is why they are not able to give you inflation beating the return. A simple product like PPF could outbeat Kotak Platinum plan. If you compare the same returns with ELSS mutual fund schemes, because ELSS mutual fund schemes invest in stock market. Kotak Platinum plan also invests in stock market. If you compare the overall return, right? A combination of term insurance plus ELSS, the same premium what you are paying, what I have assumed the example, the Kotak Platinum plan, I'm investing the same money. Only thing I'm dividing it into term insurance premium and ELSS mutual fund schemes. When I divided and ruled, it worked in my favor, right? It is giving me a very good return of 96 lakhs. Even in the best case scenario, Kotak Platinum plan is giving me only 58 lakhs, which is working out only to 6.07% in net return. Whereas ELSS historically has given 12% CAGR on an average basis in the long run, 7 years plus kind of time frame, right? Though it is giving you 12%, after adjusting it for term insurance premium, the net return works out only to 10.14%, but that itself is 96 lakhs, which is much higher than the Kotak Platinum plan. That is why the returns are definitely inflation beating. It is a risk premium return and appreciable long-term return. So what you should do as an investor? Do you have to buy Kotak Platinum plan? Is it good for your portfolio or bad for your portfolio? Because of high charges and because of lock-in period and also because of less flexibility, not able to beat inflation. Because of all these reasons, I would say you can strongly avoid Kotak Platinum plan. So what is the alternative instead of investing in Kotak Platinum plan? If you are a conservative investor who don't want to take any risk, then in that case, choose a simple combination, term insurance plan plus PPF investment. If you are someone who would like to take risk and get additional risk premium return, then in that case, if you are comfortable with stock market volatility ups and downs, anyhow, the same volatility ups and downs are there in Kotak Platinum plan also, right? You can go for a combination of term insurance plus ELSS mutual fund schemes. They will give you better inflation beating risk premium returns. The detailed analysis of this policy, we have done the complete research analysis and definitely a detailed article. We have given you the entire analysis, calculations, workings, everything in our research article. The link to the research article is given below to this video in the description box. You can click the link now and read the detailed review there. If you have any further questions related to this particular video or any other investment options, feel free to book a free appointment with our certified financial planners. The appointment booking link is given below this video in the description box. You can have a free appointment with our certified financial planners and you can discuss about your financial goals, wealth creation, or any other investment products. Also, we organize regular insightful investment webinars regularly. We invite experts and talk about good investment options. We talk about wealth creation. We talk about financial goals. People who participate in those webinars learn wealth creation strategies and investment techniques. Right. So if you also want to discover good investment techniques and strategies, feel free to leave your name and email ID below this video. In the description box, there is a webinar registration link. You can leave your name and email ID and participate in our next upcoming webinar. Your seat for the next upcoming webinar will be booked if you leave your name and email ID in the link given below this video in the description box. Hope you like this video. I'll meet you soon in the next video. Bye.